Astera Labs, trading under the ticker symbol ALAB on the Nasdaq, is showing significant volatility and upward momentum today as the market processes its massive growth indicators. Right now, the live intraday stock price sits at $297.84 per share, marking a solid upward move of 3.60% during this active trading session. This follows a previous close of $287.48. Volume is exceptionally heavy, with over 6.9 million shares changing hands compared to the normal daily average of 5.5 million. The stock has carved out an intraday high of $298.36, indicating that traders are actively pushing the boundaries of its current valuation. If you look at options activity, there is an intense amount of call volume and a massive power inflow signal pushing short-term upside pressure. While most retail investors are looking at the headline numbers, the real surprise that exceeds expectation lies in the institutional order flow. Huge blocks of shares are being accumulated through sophisticated execution platforms, which points to major fund managers locking in positions before the massive hardware product scaling scheduled for the latter half of the year. The typical narrative floating around online investing groups is that this company is just another expensive chip player riding the coattails of Nvidia stock. People look at the triple-digit revenue growth and assume it is a simple derivative play, but the reality is far more complex and interesting. The market expects Astera Labs to face immediate margin compression as larger semiconductor giants enter its space, yet the hardware profile behaves more like a high-margin enterprise software business. The company just printed a staggering non-GAAP gross margin of 76.4% in its first quarter report. That number defies typical hardware economics. When retail traders log on to popular investing sites or check their individual brokerage accounts, they see a price-to-earnings multiple hovering near 165 times. To the untrained eye, that looks like an absolute bubble ready to pop. The contrarian take here is that traditional valuation metrics are completely broken when applied to infrastructure bottlenecks. If you are tracking this through a Fidelity brokerage account or managing your assets via a high-end platform like Fidelity Wealth Management, you have to realize that hyperscalers are not buying these components based on price sensitivity. They are buying them because a data center without optimized connectivity loses millions of dollars every single hour in idle computing power. Let us break down the massive tug-of-war happening right now between short-term trading momentum and long-term institutional backing. If you monitor order tracking on a Robinhood trading platform or look at active positions inside Interactive Broker stock trading setups, you will notice that retail positioning is highly speculative around earnings dates, while institutional assets are sticking around. This disconnect between public sentiment and actual corporate execution is massive. Everyone is focused on the fact that several company executives, including the chief executive officer and chief operating officer, recently filed to sell shares. The immediate reaction on social media platforms and standard online investment forums was panic, with people assuming the insiders knew the top was in. But looking deeper into the regulatory filings reveals that a massive portion of those sales was automatically executed to cover tax withholding obligations from vesting equity awards. This is a routine corporate mechanism, yet the market treated it as a directional signal. This is exactly where the tension between expectation and reality creates massive trading opportunities for people who know how to parse actual data from headline noise. The trading activity over the last 48 hours reveals an incredible concentration of liquidity. Institutional desks are aggressively defending the mid-$200 range every single time the stock shows even a minor pullback. This tells us that major capital allocators who oversee massive portfolios, whether they are constructing passive structures like Fidelity ETFs or managing active Fidelity mutual funds, are looking at this asset as an essential foundation for the physical infrastructure of artificial intelligence. If you are doing self-investing through basic accounts, it's incredibly easy to get shaken out by a 5% daily swing. But when you look at the macro picture, the high volume on up days shows that big money is buying the breakouts. The broader tech sector has faced minor headwinds from macroeconomic pressures and shifting interest rate expectations, but connectivity providers are isolated from those broad fears because their addressable market is expanding regardless of the near-term economic cycle. Comment below how many shares of Astera Labs you currently hold or if you are looking to buy on the next dip. To truly understand why the market is assigning such a premium to this business, we have to look closely at its core commercial offering. The company does not build the heavy processing brains like the central processing units or graphics processing units that grab all the mainstream headlines. Instead, it creates the highly specialized connectivity glue that connects these massive processors inside data center racks. Their flagship Scorpio Smart Fabric switch family is the actual architecture that allows thousands of graphics processors to talk to each other without latency delays. Think about a massive highway system where every car is a high-speed data packet. If the exit ramps and interchanges are narrow, it doesn't matter how fast the cars can travel on the open road, you still get a massive traffic jam. Astera Labs builds the ultra-wide, intelligent interchanges that prevent data bottlenecks. Hyperscalers are expanding their training pods to tens of thousands of individual clusters, and the physical distance between these units introduces signal degradation. The company company's hardware boosts, cleans, and routes these signals across complex networks. Their technology platform integrates advanced protocols like Compute Express Link, Next-Generation Ethernet, and open scale-up networking standards with their proprietary Cosmos software suite. This software layer is what gives them an immense competitive advantage, allowing data center operators to monitor signal integrity and optimize their hardware layouts in real time. If we look back at the origins of the business to see how it reached this massive scale, it was founded back in 2017 by 3 engineers who left comfortable roles at Texas Instruments. They noticed that as cloud computing scaled, data center connectivity was failing to keep pace with the massive computing needs of early machine learning models. Operating initially out of a simple garage, they adopted a fabless semiconductor model, choosing to completely outsource the complex physical manufacturing of their designs to world-class foundries like Taiwan Semiconductor Manufacturing Company. This allowed them to remain incredibly capital light and focus entirely on research, development, and system architecture. The venture gained early backing from elite tech investors and later raised a major Series C funding round that was backed significantly by Fidelity Investments. This early capital allowed them to expand their footprint, launching dedicated design centers across North America and eventually establishing a major engineering presence in international tech hubs like Bengaluru and Tel Aviv. The company officially listed its shares publicly in March of 2024, and since that initial public offering, its financial trajectory has been completely vertical. In less than 2 years, their annual revenue run rate went from just over $100 million to hitting more than $300 million in a single quarter. This brings us directly to the future outlook and the critical catalysts that will dictate whether this current valuation can hold up over the next 12 to 18 months. The central pillar of the bull thesis is the massive production ramp of the Scorpio X-Series switch line, which began shipping in initial volumes earlier this year. Management has explicitly stated that they expect this specific product category to surpass their older lines to become the largest single revenue driver by the end of calendar year 2026. This scaling coincided with a massive $2 billion shelf registration filing, which gives the company immense financial flexibility to fund rapid inventory expansion and secure manufacturing capacity at prime foundries. When you look at how this impacts the broader financial landscape, it places them directly in competition for capital with established giants. Investors who traditionally parked capital in Apple stock, Tesla stock, or broad chip names are reallocating a portion of their high-growth budget to connectivity specialists. If you manage an individual brokerage account or utilize a digital system like SoFi Invest, you are likely noticing this structural shift across the entire semiconductor ecosystem. However, the reality of investing in an asset with a triple-digit multiple means you have to be sober about the operational risks. The biggest near-term risk is extreme customer concentration. A tiny handful of cloud hyperscalers account for the vast majority of their total order book. If a single major cloud provider decides to delay its data center build-out by even a single quarter, or attempts to develop an in-house custom connectivity solution, the revenue impact on this company would be immediate and severe. Furthermore, because the stock is a favorite among active traders using high-leverage platforms like Interactive Brokers Trading or tracking rapid data on the Robinhood app, any earnings report that merely meets expectations rather than completely shattering them can result in a massive 20% drop in a single trading session. We have seen this pattern play out repeatedly across the artificial intelligence supply chain. The market prices in absolute perfection, leaving zero margin for execution delays or foundry supply constraints. As we look toward the final half of the year, the ultimate direction of the stock will depend entirely on how the actual product deployment matches up against these massive expectations. If the Cosmos software platform can successfully scale into a predictable recurring revenue stream, it will permanently justify these ultra-high margins and protect the company from the cyclical downturns that historically plague the physical chip market. On the other hand, competitors successfully commoditize the open scale and networking layer. The pricing power could erode far faster than the bulls want to admit. For investors navigating the space via comprehensive platforms like SoFi Investing or setting up automated balances through a Schwab Intelligent Portfolios account, diversification across the entire infrastructure stack remains the smartest way to manage this volatility. To wrap everything up, today's active market movement highlights the massive gap between what the casual observer believes about this stock and what the underlying corporate execution shows. The prevailing expectation was that insider selling and a sky-high price-to-earnings multiple would stall the upward trajectory of the asset. The reality is that an exceptional 93% year-over-year revenue growth rate, coupled with software-like gross margins and an imminent product scaling cycle, continues to draw massive institutional accumulation. While the stock remains an absolute lightning rod for short-term trading volatility across major online investing tools and Fidelity IRAs alike, its strategic position as the indispensable connectivity architecture for high-density computing clusters makes it one of the most fundamentally sound pure plays on the expansion of physical data infrastructure. Keep a close eye on the volume trends during any minor pullbacks, because that is where the true institutional sentiment will reveal itself. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, unshare with your friends. Subscribe for more updates.